What's the process for somebody to get approved for a loan? I mean, mostly now they fill out an application online.
Yeah, everything is pretty much done online.
Okay.
They fill out an application that's going to go over their just their basic information, a little bit of employment history. Once again, a lot of them are self-employed because they're real estate investors. Mm-hmm. And then we get copies of their bank statements.
Okay.
So we're able to tell by the bank statements that this person either has the ability or has been doing it, or, a lot of times you can just see in their bank statements that they're already doing the business.
Correct. Big chunks go in and out.
Big chunks in and out.
Yeah.
And what's real good about that, the reason why we get the bank statements, alluding to something I said earlier, a lot of times you'll have somebody and they send in somebody else's bank statements.
Right.
Well, that might work, once again, as long as they're both on board and they understand the risk, and we probably want to get the person with the money to actually sign, or at least co-sign.
Yeah.
So we learn a lot by the bank statements, like who has the money. A lot of times, where is it? If it's in an IRA, are they going to be able to take it out? Different things like that. So those are the main things. And then, like I say, we do a credit report, and that's, to the bank people, that seems oversimplified. But once again, because of the track record, we feel like that's a conversation with them along with the basic application and their bank statements seems to really work for us.
And that whole process takes what?
Or should I make it sound better than it is? A half hour? No.
I mean, it doesn't take forever.
It really doesn't take long.
Right.
I mean, it's a very simple concept.
And I think people would be surprised at how often we say no.
That would be staggering, I think.
And I think that's one thing a trustee investor couldn't possibly appreciate until they understand the difference between what we fund and what other people say yes to.
Right.
Because we say no to a lot of people where you go, okay, really? Because I heard hard money lenders are like this,
Right.
And you find out, well, you might find some of those, but boy, that's not here, because we're really trying to make loans that are good for the person with the money too.
Yeah, and one thing I often say is, if you're going to have a lending business, the most important thing you need is money. So you have to be able to lend.
Yes.
And so that's why you pick your borrowers wisely, because I can't tell you how many calls I get from some investor wanting to borrow money that said, hey, can you help me with this deal? I got 12 hours to close it because my other lender ran out of money or couldn't fund it in time. Well, unfortunately, that deal might be lost for him, but I say, hey, listen, let us do it next time. We'll get it funded for you.
I think, when you referred to me as a borrower of hard money when you and I first met, that was really the criteria. It was a piece of my puzzle that I didn't have to think about anymore.
Right.
And I could go to the HUD auction. Remember you guys giving me $1 million credit letter. Right. And I felt like a free man because there were the deals.
Right.
And so I was able to go, okay, I can get these things at half price. And I was ecstatic because it opened up a whole new world. And I know there's a group of investors that really think it's a wise idea. Well, I'm going to go find my own money.
Right.
Well, that's a tougher deal than they think. It's not easy to get somebody to trust you with their money, and it's not easy for that private investor to look at the property with experience enough to say this is safe or it's not safe. That's where a team taking care of that is much safer for them.
Exactly, and I think the borrower sometimes, they don't realize that looking for the money, that might save them money, but when you count in the factor that it's like a part-time job,
oh yeah,
I don't know if it really effectively saves them money.
No, they could find one more deal and forget the points.
Yeah, they could spend that money exactly doing something that's going to make them money, and a lot of people, but some people choose to do that, but I don't think it's effective cash-wise.
Out of the properties that we loan on, what percentage end up being single-family homes?
I'd say 90+%.
Way in the 90s, yeah. Or 2 to 4 units might make up most of the other.
Yeah. It's definitely almost all single families with a few small residential up to 4 units.
One of the things that we, just again with experience, we don't loan in second position.
Yeah, that's just something.
I mean, even if there's equity, it looks okay, and and then all of a sudden you find out why you don't want to be in second position.
Yeah, it's just one of those things. I mean, maybe it's right for somebody else to do that, but
Yeah.
for us, we just have that formula that we've always done, and we're able to get enough clients with how we do it, and I just don't think that's something that we've stepped into.
I think that's what happens eventually is you realize that, okay, we have a very successful model that this is what we're the best at, and we'll just keep doing that, and we'll find ways to get more of that rather than, say, branch out into something else that's not that model.
Exactly, and I mean, we talked for length, I mean, because the education that you do, I mean, that's really statewide. You're followed statewide. And at one time, we were thinking Northern California would be a natural progression for us.
Right.
And it was, it was hard to duplicate doing something at such a remote location compared to how we had it here. And we made the decision to just concentrate on what we really knew like the back of our hand.
And I think, honestly, that speaks to what we want to try to accomplish for our customers, because the truth was we weren't experts in Northern California. When somebody said they had a home in Sacramento or some other city, we didn't know the difference. Where here we do.
Yes.
And we just felt a little bit of a discomfort level, and then you're relying on appraisers completely, and that just, it wasn't where we wanted to go.
No, and here, not only us, but our surrogates, meaning our appraisers, I mean, they know the difference between one block.
Exactly.
And that's where a lot of novices, that's where, whether it be borrowers or lenders, you can have somebody that really isn't familiar with an area. You can have somebody say, well, look, here's all the comps, and it might look at one value. I might send it to Rick, our appraiser, and he can say, well, that's not really the case, because as you can see here, this is why it's not worth that extra 20 grand.
Yeah,
and that's a big deal.
When you start funding loans where you have that flaw, you could be at a very different percentage loan to value awfully quick.
Yes.
And that's important. The paperwork that people get, a lot of times they're not familiar with it. You and I have signed it a bunch of times, or we probably don't think about it anymore, but first time you see it, you probably think about it. So a couple pieces of paper. What's an investment bulletin?
The investment bulletin, basically, that's going to be, I guess the best way to put that is like a summary.
Yeah, it's like a one-page.
Yeah, so that's just kind of a one-page thing that we create that says a little bit about the borrower, a little bit about the property, a little bit about your note. So it just kind of summarizes the transaction. Lender
purchase disclosure statements?
Those I would say there's several ones in there. There's also something escrow related. Those two are very similar to what you'd say, just the general part of escrow instructions.
Okay.
So let's say if you've bought a house before, the escrow instructions tend to have one page that has some specifics on it, and then a lot of pages that are more general.
Right.
That's kind of what I relate those to.
The loan servicing agreement. Now, we service all the loans that we fund. Is that
yes.
That's correct?
Yes.
Okay. And the reason that we've decided that that's important?
Well, we've decided that's important because not only do we want to give service to the lender that's lent us the money, but also the borrower who's borrowing the money. So us being able to do the servicing allows us to react quickly if we need to do something with regards to a demand or something like that. And for people that aren't familiar with what a demand is, basically if somebody wants to sell a house and pay off your loan, they need a demand. Well, over the years, we realize a lot of time the investors, they might be on vacation or they might be, somewhere else. So with us servicing, we can say if somebody needs a demand so they can close the escrow, we can do that right at the office very quickly. That's maybe just one example.
Well, and we have several people doing that function, and
yes.
You can imagine if you're servicing your own loan, some of your time would be spent doing what we're doing for you automatically.
Yeah, and we talked earlier about the fire insurance. Somebody might, fire insurance, that's, that's not much, but when you realize all the work that can go into that, it can become time consuming, and that's something, most investors just don't want to do.